This is Reporting Matters. The Corporate Accounting Podcast starts now.
Usually when we talk about a job interview, there's this sort of expectation of a script, like a highly choreographed dance.
Right, yeah. Both sides definitely know the steps before they even walk in.
Exactly. You put on your best suit, they ask what your biggest weakness is, and you say something incredibly safe. Like, oh, I just care too much, or I work way too hard.
Which is just a comfortable little game of pretend, really. It's predictable to the point of being entirely useless for figuring out how someone actually performs under real pressure.
Totally useless. But then you step into the corporate arena in Amsterdam, and suddenly the music completely stops. You're in a totally unforgiving landscape.
Oh, absolutely. It's a completely different world out there.
You are sitting in an all-glass boardroom at a massive multinational corporation. And if you try to tap dance your way through an answer, you are instantly disqualified.
Yep. They will see right through it in a heartbeat.
So today, we are cracking the code on exactly how to survive and honestly dominate that exact boardroom. Your mission today is highly specific, but the stakes are astronomical.
Because you're aiming for a corporate accountant role at a major multinational corporation, an MNC, right in the heart of Amsterdam.
Which is an entirely different beast compared to interviewing at a domestic firm. Even a large domestic firm anywhere else in the world.
Amsterdam is just this unique ecosystem. You really can't compare it to anything else.
Exactly. We are talking about the global hubs for absolute titans. Booking.com, Heineken, ASML, Philips.
Massive, massive players.
So today we are going to structure this deep dive as an intensive mock interview session. We've got our prep guide and we're going to put you right in the hot seat.
I love this approach. It's the best way to actually prepare.
We are going to guide you through the behavioral gauntlet, the highly technical scenarios, the enterprise software requirements, and crucially, the unique cultural nuances of the Dutch corporate world.
Because, frankly, if you don't understand the culture, your technical skills simply will not matter. They won't even look at your spreadsheet skills.
Right. And we really need to emphasize the sheer scale of the environment you are trying to enter. When you sit in that interview chair, you aren't just interviewing for a job where you tally up receipts.
Far from it. You are having to prove in real time that you can survive and thrive in an ecosystem that is aggressively transparent.
Aggressively transparent, yeah. And heavily data-driven and incredibly fast-paced.
So let's not waste any time. Let's just jump right into the deep end.
Let's do it. Because before we even touch the complex math or the software systems or the international reporting standards, we have to talk about the culture.
It is the absolute foundation of the whole process.
How you answer a question in Amsterdam is just as important, if not more important, than the answer itself. We have to start with what we're calling the Amsterdam factor.
It's the only logical place to start. If you fail the cultural fit, the technical interview won't even happen. They will just end the process right there.
Wow, just cut it short.
Oh yeah, thank you for your time. We'll be in touch. And you'll never hear from them.
Okay, so let's set up our first mock scenario to make sure that doesn't happen. Let's call this the knowledge trap.
The knowledge trap. I like that. It's very real.
You are in the interview. The hiring manager leans across the table and asks you a highly technical, incredibly obscure tax or revenue recognition question, and your mind goes completely blank.
A nightmare scenario for any candidate.
Right. You simply do not know the answer. Now, my instinct, and I think the instinct for a lot of people, is to try and pivot.
The classic politician move.
Exactly. If they asked me about, say, IFRS 9 hedge accounting, and I have no idea, I'd probably say something like, well, my core competency is actually in operational risk mitigation, and here's how I approach that.
Trying to show them you're smart in a different area.
Yeah, exactly. Isn't that just basic interview survival? You never just say, I don't know, right? You keep the conversation moving.
If you do that in Amsterdam, you just lost the job. It's a fatal flaw.
Right. Wait, really? Just completely dead in the water for trying to be conversational and pivot.
Absolutely dead in the water. What you are running into here is the principle of Dutch directness. It is the absolute cornerstone of their corporate culture.
Dutch directness. Okay. Break that down for me.
They value clarity, conciseness, and above all, absolute honesty. If you try to fake an answer, or if you try to pivot and answer a question they didn't ask just to sound smart, they notice immediately.
They see the pivot happening in real time.
Yes. And they will view it as a fundamental lack of integrity.
Wow. Because you're essentially dodging the reality of the situation.
Exactly. Think about the role you are applying for. In a finance role at a multinational, trust in the numbers is literally everything.
Right. Millions of euros are on the line.
Billions, sometimes. The executives are making massive decisions based on the data you provide. If they ask you a question and you try to spin them a story instead of giving them the facts, you are proving you can't be trusted.
You're proving that when the pressure is on, you'll obscure the truth to protect your own ego.
Precisely. Faking it is the ultimate red flag in that environment.
Okay, that is a huge shift in mindset. So what is the survival tactic then? If I can't guess and I can't pivot, what exactly am I supposed to say?
You look them directly in the eye and you say exactly this. I haven't encountered that specific scenario yet, but my process to resolve it would be checking the IFRS standard and consulting our internal technical accounting team.
Okay, let's pause and really look at why that works. Because honestly, to my ears, I'm still admitting defeat. I'm literally saying out loud, I don't know.
But you aren't admitting defeat at all. You are demonstrating your process.
Showing them how I think.
Exactly. What's fascinating here is that the interviewer will often ask an impossibly obscure question specifically to see if you will try to lie to them.
Oh, wow. So it's a literal trap.
It is entirely a trap. By using that response, you are doing 3 highly strategic things simultaneously. First, you show unshakable honesty. You don't know, and you are confident enough to admit it without getting defensive.
Okay, that covers the Dutch directness piece. What's the second thing?
Second, you show a methodical approach. You don't panic under pressure. You immediately shift into problem-solving mode.
Right. Here is how I would find the answer.
Yes. And third, you show that you understand the corporate ecosystem. You know to check the official framework, the IFRS standard.
And you know to leverage internal resources, like the technical accounting team. You aren't just a lone wolf guessing in the dark.
Precisely. You just turn a moment of ignorance into a demonstration of ultimate competence.
That is such a powerful perspective shift. Yeah. It's really not about acting like a walking encyclopedia. It's about showing them how you navigate the unknown.
You're proving you are a safe pair of hands. That's what they want.
Okay, let's move to another major cultural pillar in the prep guide, the concept of flat hierarchies.
Oh, this is a huge one for international candidates to grasp.
Yeah, the guide says that in these Amsterdam headquarters, accountants are absolutely not viewed as back-office bean counters. They are expected to be business partners.
Which is a crucial distinction that trips up a lot of people. In many traditional corporate structures around the world, the accounting department is deeply siloed.
Right, they sit in a quiet room, crunch the numbers, and that's it.
Exactly. They generate the reports, email them off to the executives, and that's the end of their involvement. A flat hierarchy completely dismantles that dynamic.
So what does that actually look like in the interview? Let's put you in the hot seat for a second. Let's say the interviewer says, tell me about a time you disagreed with a department head over a budget.
Okay, so in a traditional culture, your answer might be, I pointed to the company policy and informed the marketing director that their request was denied due to budget constraints.
Which sounds perfectly reasonable in a lot of companies. You're enforcing the rules.
But in Amsterdam, if you give that answer, you've failed the question.
Because you're acting like a cop, not a partner.
Exactly. Your answer needs to show that you can sit at the table with other departments, sales, marketing, operations, and actually speak their language, not just accounting jargon.
Okay, let's make this real with a scenario. Operations wants to buy a massive new piece of logistics machinery, but they are already over their capital expenditure budget for the quarter.
A very classic corporate conflict.
Right. So how does the business partner handle that conflict without just stamping denied on the form?
A business partner translates complex financial realities into actionable insights for those non-finance stakeholders.
So you don't just say, your CapEx budget is exceeded by 20%.
No. You sit down with the head of operations and say something like, I see the ROI on this new machinery is fantastic. However, we are currently capped on capital expenditures for Q3.
Setting the boundary, but acknowledging their goal.
Yes. But if we look at your operational expenses, we have a surplus in your supply chain logistics line item. If we lease the machinery instead of buying it outright, we can shift this from a CapEx to an OpEx.
Oh, that is slick.
We get you the machinery next week, and we stay entirely within our corporate compliance framework.
That is a brilliant answer. You aren't the police. You are a strategic advisor.
You are showing the interviewer that you don't just report the news, you actually help make the weather.
I love that phrase. You navigate cross-departmental conflict, not with bureaucratic rules, but with collaborative, data-driven solutions.
Precisely. You have to prove you can hold your ground with senior leaders using data to drive the business forward, not hold it back.
You're basically a diplomat armed with a spreadsheet. Now, speaking of diplomacy, there is another massive component to the Amsterdam factor we need to hit: extreme diversity.
Yes, this is unavoidable. If you are aiming for Booking.com or Heineken or Philips, you are not stepping into a Dutch company.
Right, you are stepping into a global company that just simply happens to have its headquarters in the Netherlands.
Exactly. These hubs are hyper-international. You walk into the cafeteria and you might hear 20 different languages before you get your coffee.
So when you are preparing your anecdotes for this behavioral interview, you cannot just talk about resolving a conflict with the person sitting in the cubicle next to you.
That's way too small scale. You must prepare anecdotes that highlight your ability to navigate cross-border teams.
You need a specific story ready to go about coordinating a complex project across vastly different time zones and cultures.
You have to show you understand the friction of global communication and, more importantly, how to smooth it out.
Give me an example of that friction. What kind of problem are they looking for you to solve?
Think about the month-end close process. You have a hard deadline to report the company's financials on the 5th of the month.
No exceptions. The 5th is the 5th.
Right. But you have a subsidiary in Tokyo that needs to submit their numbers, a regional manager in Amsterdam who needs to approve them, and an external auditor in San Francisco who needs to review them.
Okay, so Japan is what, 8 hours ahead of Amsterdam? And San Francisco is 9 hours behind. That's a nightmare.
It is. If you just wait for emails to bounce back and forth sequentially, you will miss the deadline by a full week.
So what's the solution you bring up in the interview?
You need to casually explain how you proactively aligned that workflow. Perhaps you set up a rotating bridge call or established a shared cloud dashboard that everyone updates asynchronously.
You have to prove that the global scale doesn't intimidate you. It's just a logistical puzzle you already know how to solve.
Exactly. It's just a process issue to you, not a panic-inducing crisis.
Okay, so you've established that you have the honesty, you have the collaborative spirit, and you have the global mindset. You've survived the cultural behavioral gauntlet.
Which is a huge achievement in itself. But here's where it gets really interesting.
Right, because you are expected to be this dynamic strategic business partner. The company knows you cannot possibly be spending 40 hours a week manually typing numbers into a ledger.
Which naturally leads us to the next phase of the interview. You have proven you fit the culture. Now you have to prove you have the tool.
You are entering the systems and automation inquisition.
The technical screening of your digital skills.
Right. So here is your next mock interview question. The interviewer looks at your resume, taps a pen against the table, and says, walk me through your experience with ERP systems and how you optimize workflows.
A very standard but very loaded question.
Now, I want to push back here on behalf of every accountant listening. Let's say I have been using Microsoft Excel like an absolute grandmaster for 10 years.
A wizard with the spreadsheets?
Exactly. I'm talking deeply nested VLOOKUPs, complex VBA macros, dynamic arrays, the works. I can make Excel do backflips. Why isn't that enough? Why do they care so deeply if I know a specific brand of enterprise software?
Let's use an analogy here to make it clear. Excel is a highly customized Swiss Army knife.
Okay.
It is a brilliant tool, and in the hands of a master, it can do almost anything on a small scale. But a massive multinational corporation isn't a campsite, it's a massive automated factory floor.
Oh, I like that. Break that down for me. Why doesn't the Swiss Army knife work on the factory floor?
When you are dealing with millions of individual transactions happening every single day, across 50 different countries, in 20 different currencies, a Swiss Army knife is useless.
It just can't handle the volume.
Not at all. If you try to run a multi-billion-dollar consolidation in Excel, the file will crash, the data will corrupt, and a single fat-fingered keystroke could accidentally wipe out 10 million euros of revenue.
Which is terrifying. So multinationals operate at a scale where manual data entry and spreadsheet linking is virtually extinct.
Completely extinct. Excel mastery is just the baseline expectation. They assume you are a grandmaster. What they need to know is if you can operate the heavy machinery on the factory floor.
And the heavy machinery in this case is the ERP, the Enterprise Resource Planning System.
Yes, the ERP is the core.
What are the specific names I need to be dropping here to show I know how to operate this machinery?
You need to highlight experience with Tier-1 enterprise systems, the absolute gold standard for massive multinationals, especially manufacturing and product-heavy companies like ASML or Heineken, is SAP. Yes, specifically SAP S/4HANA.
Okay, let's pause there. SAP S/4HANA. It sounds like a droid from Star Wars. What actually is it, and why is it so important to mention that specific version?
Think of SAP as the central nervous system of the entire global company. It connects absolutely everything.
Give me a real-world example of how it connects things.
Okay, when a worker in a factory in Brazil scans a barcode to load a pallet of beer onto a truck, SAP instantly updates the global inventory.
Right.
It automatically triggers an invoice to the customer, updates the accounts receivable ledger in Amsterdam, and recalculates the cost of goods sold. All instantly, all without a single human touching a spreadsheet.
Wow. And S/4HANA is just the newest engine running that.
Exactly. S/4HANA is their newest version, which runs entirely in the cloud and processes massive amounts of data in real time.
So if you have experience navigating that system, or better yet, if you were part of a team that migrated an old system into SAP S/4HANA, that needs to be the centerpiece of your answer.
It absolutely needs to be front and center. It proves you can operate at their scale.
Are there other systems besides SAP that hold the same weight if the candidate comes from a different industry?
Yes, for sure. For tech giants or service-based multinationals like a Booking.com, you will often see Workday Financials or Oracle NetSuite.
Okay, Workday and Oracle.
Yeah. They operate on the exact same principle. Massive, cloud-based, centralized data. You have to prove you are comfortable navigating within these massive digital ecosystems.
Okay, so I've name-dropped SAP or Workday. I've shown them I can operate the factory floor. But the interviewer is going to dig deeper, aren't they?
They will. They want to know how you optimize that data. They want to see your data fluency.
Right. If I can't just talk about my fancy Excel macros, what are the magic words here to show I'm fluent?
The magic words are Power Query, Advanced Pivot Tables, and Business Intelligence or BI tools.
Let's explain those for anyone who might not be using them daily. What is Power Query, and why does an interviewer care if I know it?
Power Query is essentially a data connection and shaping tool.
Shaping tool, like molding clay.
Sort of, yeah. Imagine you have to pull a daily sales report from SAP, an inventory report from an older legacy database, and a currency exchange spreadsheet directly from the European Central Bank.
Okay. 3 totally different sources.
Right. Instead of manually copying and pasting all of that into one master file every single morning, Power Query allows you to build an automated pipeline.
So you tell the system what to do once.
Yes. You say, go grab data from source A, source B, and source C, clean out the errors, match the columns up, and drop it here. You build it once, and then every morning you just hit refresh.
You are literally turning hours of manual labor into a single click of a button.
Exactly. That's what they want to see. And then you mentioned BI tools like Microsoft Power BI or Tableau.
What did those add to the mix?
This shows that you don't just store and clean data. You know how to extract it and visualize it.
Visualizing is key for those non-finance business partners we talked about, right?
Exactly. You can turn a spreadsheet with 3 million rows of boring data into a clean, interactive dashboard. One that shows the CEO exactly which product line is losing margin in real time. That is what data fluency actually means.
You are turning raw, overwhelming data into actionable insight. I love that. Now, there's a very specific, almost mandatory requirement for this part of the interview in the prep guide.
Yes, the automation story.
Right. You must have a prepared anecdote about a time you automated a manual process.
It is an absolute staple of the Amsterdam MNC interview. They want to see that you are actively looking for ways to make the machine run faster.
Okay, so if I'm in the interview and I say, I built an Excel macro that automatically formats our daily sales report and highlights any negative margins in red, it saves me about an hour every morning.
Okay.
That proves I know automation, right?
If you say that in Amsterdam, they will smile politely, finish the interview, and you will likely never hear from them again.
Ouch. Really? Okay, why? Saving an hour a day is 5 hours a week? That's a lot of time. I would be proud of that.
I mean, it is a lot of time for you personally, because formatting a sales report is a localized personal efficiency. It's a nice trick, but it doesn't move the needle for a multi-billion-dollar company.
Ah, I see. It's too small.
Exactly. They aren't looking for personal spreadsheet hacks. They are looking for enterprise-level automation. Your story needs to be illustrative of solving a massive systemic bottleneck.
Okay, so let's rebuild my story. What does a winning automation anecdote actually sound like?
You frame it around a major operational pain point. For example, accounts payable.
Always a bottleneck.
Always. So you tell the interviewer, when I started my last role, I noticed our AP team was spending massive amounts of time manually typing invoice details into the system. So I led a project to implement an OCR tool to automate the workflow.
Hold on, let's explain OCR. What exactly is that acronym?
It stands for optical character recognition. It's software that can read an image or a PDF and actually extract the text.
So like a digital eye.
Exactly. So instead of a human looking at a PDF invoice from a vendor and manually typing the date, the amount, and the vendor name into SAP.
Which takes forever and causes typos.
Right. The OCR tool scans the email, extracts all that data automatically, and pre-populates the fields in the accounting software. It essentially eliminates manual data entry completely.
That is a massive systemic upgrade. But how do I land that story in the interview? What is the punchline they're waiting for?
The punchline is the math. You must quantify the result. You never, ever just say, it saved a lot of time.
Dutch directness again. Give them the facts.
Exactly. You give them the exact metric of success. You finish the story by saying something like, by implementing the OCR tool, we reduced invoice processing time from an average of 5 minutes per invoice to 30 seconds.
That's a huge drop.
And then you scale it. Over our volume of 10,000 invoices a month, this eliminated 750 hours of manual data entry, allowing us to reassign 2 full-time employees from data entry to vendor relationship management and strategic discount negotiation.
Wow. You didn't just save time. You restructured the capability of the entire department. You took data entry clerks and turned them into strategic negotiators.
That is exactly the kind of business partners thinking they want to hire.
You've proven you won't lie to them. You can work across time zones, and you can program the machines to do the heavy lifting. You are looking like the perfect candidate at this point.
You're doing great, but you're not done yet.
Right, because the interviewer shifts gears again. Because having the right mindset and the right digital tools doesn't mean anything if you don't actually know the rules of the game at a global scale.
Which brings us to the technical gauntlet. And in Amsterdam, that means proving absolute, unquestionable mastery over the IFRS framework.
Okay, let's establish a massive baseline rule right away for this section. Multinational corporations in the Netherlands report almost exclusively under IFRS.
That's International Financial Reporting Standards.
Right, or occasionally US GAAP, if they are dual listed on an American exchange. But it is universally understood from the prep guide that you should completely ignore Dutch GAAP for this interview.
Oh, this is such a massive trap that local candidates fall into all the time.
Really? Why do they fall for it?
They want to show off their local knowledge, so they start referencing the Dutch accounting rules, the richtlijnen voor de jaarverslaggeving.
Which sounds impressive to know.
It does, but an MNC like ASML simply doesn't care about local Dutch accounting rules for their consolidated corporate reporting. They are playing a global game, and IFRS is the global language.
So bringing it up just shows you don't get it.
Exactly. If you start quoting Dutch GAAP, you are inadvertently showing them you don't understand the sheer scope of the role you are applying for. Stick to IFRS.
Okay, so let's throw you into the technical deep end. Here is your mock interview question. The interviewer says, walk me through your experience with multi-entity consolidations.
A classic.
Now, multi-entity consolidation sounds like a phrase designed in a lab to put people to sleep, but it's actually the lifeblood of a multinational, isn't it?
It really is the core of what they do, and this is where you must immediately deploy your knowledge of IAS 21.
Which is the standard that deals with foreign exchange, or FX translation. Let's unpack the mechanics of this because I know it's incredibly complex.
It's very complex. Let's use an example to make it tangible. Imagine Heineken.
Okay, great example.
They have a subsidiary in Mexico selling beer in pesos. They have a subsidiary in the UK selling in pounds, and a subsidiary in Japan selling in yen.
So money is coming in from all over the world in different formats.
Right, but at the end of every single month, the corporate headquarters in Amsterdam needs one single unified financial report presented in euros.
So how do you mathematically merge all of those different currencies together?
That is multi-entity consolidation. And the nightmare is that the exchange rates are constantly fluctuating.
Right, a peso isn't worth the same amount on Tuesday as it was on Monday. The target is always moving.
Exactly. So your answer needs to break down exactly how you handle that volatility. You have to explain to the interviewer that you understand the specific rules of translation under IAS 21.
Give me an example of one of those rules.
For instance, when translating a foreign subsidiary's balance sheet, you use the closing spot rate. That's the exact exchange rate on the final day of the month.
Makes sense. A snapshot in time.
But for the income statement, for the revenue and expenses that happen throughout the whole month, you generally use the average exchange rate for that period.
Wait, so you're using two different rates for the balance sheet and the income statement?
Yes.
But then the math isn't going to balance perfectly at the end.
Right. You've spotted the issue, it creates a mathematical discrepancy, and you have to tell the interviewer exactly where that discrepancy goes. You explain the critical difference between realized and unrealized FX gains and losses.
Let's clarify that for the listener. What is the actual difference between realized and unrealized?
A realized gain or loss happens when actual cash changes hands.
Actual money moving.
Yes. If you buy a server from the US for $1,000, and by the time you actually pay the invoice a month later, the euro has weakened, you literally have to spend more euros to buy those dollars.
So you lost real money on the exchange.
Exactly. That is a realized loss, and it hits your income statement directly. It lowers your actual profit for the month.
Okay, that's realized. What about unrealized?
An unrealized gain or loss is just paper math. It's the discrepancy we talked about from translating the Mexican subsidiary's assets into euros at the end of the month.
Because you didn't actually sell the brewery in Mexico.
Exactly. You haven't actually sold the asset, so you haven't really lost or gained any actual cash. It's just a valuation difference.
So where did that paper math go if it doesn't hit the profit?
That unrealized translation difference goes into a special bucket in the equity section of the balance sheet. It's called Other Comprehensive Income, or OCI.
OCI. Okay, so if you can articulate that difference in the interview, you prove you actually understand the mechanics of FX, not just the buzzwords.
Absolutely. But there is a secret weapon here to really blow them away on this specific topic.
The golden bonus point from the prep guide.
Yes. To absolutely nail this IAS 21 question, you should casually mention the recent amendments regarding the lack of exchangeability.
Lack of exchangeability. What is that, and why does mentioning it make you look like a rock star candidate?
This is a brilliant strategic move to show you are way ahead of the curve. Usually, converting currencies is easy. You just look up the market rate on Bloomberg or whatever.
Public info.
But sometimes a currency simply cannot be exchanged into another currency. This could be because of extreme governmental capital controls, international sanctions, or total economic collapse.
Like in certain emerging markets or hyperinflationary economies.
Exactly. The government might lock the exchange rate artificially, saying it's 1-to-1, but no one can actually trade at that rate in reality.
So what do you do as an accountant? You can't just leave a blank space on the balance sheet for Venezuela or wherever.
Right, you have to report it. So the recent amendment to IAS 21 provides a specific, complex framework for estimating what a realistic exchange rate would be when a currency basically stops being convertible.
Oh, wow. So it's a whole new methodology.
Yes. By casually bringing this up, saying something like, and of course, when consolidating our more volatile emerging markets, we have to ensure our translation methodology is fully compliant with the new lack of exchangeability guidelines. You prove your knowledge isn't from a textbook you read 5 years ago.
Your knowledge is up to the minute. You're actively engaged with the evolution of your profession. I love that.
It separates the practitioners from the theorists.
Let's look at another technical area. With companies like Booking.com or a massive global retailer, we are talking about insane physical and digital scale. Millions of hotel rooms, thousands of retail stores.
Massive scale.
How does that scale change the accounting questions they're going to ask you in the interview?
The scale dictates the questions entirely. If a company relies heavily on physical locations or massive long-term digital contracts, they are going to aggressively grill you on IFRS 16 and IFRS 15.
Because for these specific companies, those two standards govern billions of euros.
Literally billions, yes.
Let's start with IFRS 16, which is leases.
Right. Let's take a step back and explain why this standard exists, because it's a big deal. Historically, before IFRS 16 came along, companies could sign massive 20-year leases for hundreds of retail stores, and they could structure those contracts as operating leases.
And what did that allow them to do?
It allowed them to keep that massive financial obligation completely off their balance sheet. It made the company look much less in debt than it actually was.
It was essentially legally sanctioned hiding of debt.
Yes, exactly. Yeah. But IFRS 16 changed all of that. Now, almost every lease has to be brought onto the balance sheet. In the interview, you must demonstrate that you understand the core mechanics of how this works now.
So what's the key term they're listening for?
You need to explain how to recognize a right of use, or ROU, asset.
Right of use asset. What exactly is that? If I lease a storefront, I don't own the building. How is it an asset?
Even though you don't own the retail store, you own the right to use it for the next 10 years. That legal right has immense financial value to your business, so it is recorded as an asset on your books. But simultaneously, you have a legal obligation to pay rent for the next 10 years, so you also have to record a massive lease liability.
So the balance sheet just balloons on both sides. Assets go up, liabilities go up.
Exactly. And you have to explain to the interviewer how that impacts the profit and loss statement, the P&L. You don't just record a simple rent expense every month anymore.
Wait, really? What do you record instead?
You have to record the depreciation of that ROU asset over time, and you have to record the interest expense on the lease liability. It fundamentally changes the EBITDA of the company.
Wow. If you are interviewing at a company with hundreds of physical locations worldwide, being able to walk through that math confidently is clearly non-negotiable.
It's the core of their retail accounting. You have to know it.
Okay, what about IFRS 15? Revenue from contracts with customers.
This is the absolute lifeblood for tech, software, and service companies. IFRS 15 introduced a very strict, complex, 5-step model for recognizing revenue.
And the goal of it is what?
It stops companies from claiming cash as revenue before they have actually earned it by providing the service.
Let's use a real-world scenario to understand how this works, instead of just reciting the 5 steps.
It's a good idea.
Let's say I go to a telecom company and I buy a brand new smartphone. I pay 1,000 euros upfront today. It comes with a physical phone, a 2-year data plan, and a free 1-year subscription to a streaming service.
A very standard bundle.
Right. Doesn't the company just record 1,000 euros of revenue today? I handed them the cash, the transaction is done.
No, absolutely not. If they did that, it would essentially be accounting fraud under IFRS 15. The interviewer is going to want you to break down exactly how you slice up that 1,000 euros.
Okay, walk me through the slicing. How does the math work?
Yeah. Under IFRS 15, you have a contract with multiple performance obligations. You have the phone, the data plan, and the streaming service. You have to allocate that 1,000 euros across all 3 items based on their standalone selling prices.
Wait, even if the streaming service was marketed to me as free?
Yes, from an accounting perspective, nothing is actually free. You allocate a portion of that 1,000 euros to the streaming service.
Okay, so the pie is sliced. Then what?
Now, here is the crucial part you must explain in the interview. When do you actually recognize the revenue for each slice? You recognize the revenue for the physical phone immediately because you handed the phone to the customer. The obligation is satisfied today.
Makes sense. I walked out of the store with it.
But the revenue allocated to the data plan, you have to defer that on the balance sheet and recognize it evenly over the next 24 months.
As the customer actually uses the data.
Exactly. And the streaming service, over 12 months.
So that single 1,000 euro payment today creates this cascading schedule of deferred revenue that hits the P&L over the next 2 years.
Exactly. That is a bundled service or multi-element arrangement. If you can smoothly explain how to allocate and defer revenue across a complex tech contract, you have proven you understand their core business model.
Okay, so you've shown them, your current rules inside and out. But how do you show them you aren't just keeping up, but that you are actually ahead of the curve?
You drop the IFRS 18 bomb. This is the ultimate curveball strategy from the prep guide.
What is IFRS 18 and why is it such a big deal to bring up?
IFRS 18 is a massive new standard covering presentation and disclosure in financial statements. It is entirely replacing IS1, which has been the fundamental bedrock of how companies present their financial statements for a very, very long time.
What does it actually change?
It fundamentally changes the face of the profit and loss statement. It introduces strict new rules for subtotals, like clearly defining what operating profit actually is, and it severely restricts how companies can use management-defined performance measures.
What are management-defined performance measures?
Those are the customized metrics companies sometimes invent to make their performance look a bit better than GAAP actually allows, like adjusted EBITDA excluding restructuring costs. IFRS 18 reins that in.
It forces standard consistency on how profit is displayed. But wait, I read this standard isn't officially mandatory until 2027. If I'm interviewing right now, in 2026, why does the interviewer care if I know about it?
Because massive MNCs do not turn on a dime. Remapping an entire global chart of accounts, altering the underlying ERP logic, and changing the profit or loss structure for a company operating in 60 countries takes years of intensive planning.
It's a massive IT and finance project combined.
Yes. Forward-looking MNCs are already deep into mapping out these changes right now in 2026 so they can run parallel reporting and test the systems before the mandatory go-live date.
Ah, I see. So it's a current headache for them.
Exactly. If you bring up IFRS 18 in the interview, if you casually say, "I'm curious, how far along is your internal team in mapping your chart of accounts to comply with the new IFRS 18 subtotals for next year?"
Oh, wow.
You instantly elevate yourself from a standard candidate to a strategic asset. You aren't just looking at this month's close. You are looking at the future architecture of their entire financial reporting process.
That is an incredible tactical maneuver. You shift the dynamic entirely. It's no longer them interrogating you, it's you engaging them as an industry peer.
Exactly. It shows profound confidence.
Which brings us perfectly to the final phase of the interview, the corporate core. Because the final test doesn't just look at culture or tech or IFRS in isolation.
No, it puts it all together.
The final test combines everything and it applies it under extreme crushing time pressure.
The scenario synthesis. This is the operational gauntlet where they see if you will break under the weight of the job.
And there is a strict mandate in the prep guide on how to answer these operational questions. You must use the STAR method: situation, task, action, result. Why is this specific framework so critical for these high-pressure questions?
Because under pressure, human nature is to ramble. When someone asks you about a highly stressful situation, you tend to start venting or telling a messy, disorganized story about who sent what email to whom.
Right, you get lost in the weeds.
The STAR method forces you to be structured, objective, and concise. Remember that Dutch directness we talked about?
Yeah.
The STAR method is the operational version of that. It ensures you clearly define what the crisis was, what your specific responsibility was, the exact mechanical steps you took to fix it, and the quantifiable outcome. It proves you can communicate clearly when the house is on fire.
All right, let's put you in the hot seat with a nightmare scenario. Here is your final mock interview question. Walk me through how you prioritize your workload when quarter-end close overlaps with an external audit deadline and a major ERP system update.
Just a horrific week in finance.
My immediate reaction to that question is, come on, that sounds like a hypothetical torture scenario designed purely to see if I will start sweating through my shirt in the interview. Does a situation that bad actually happen?
It absolutely happens constantly. It is the reality of the fast-paced corporate cycle. A massive MNC operates on a brutal, unforgiving timeline. We are talking about a 3 to 5 day month-end close.
3 to 5 days.
Yeah.
For the whole globe.
Yes, they lock the financial books for the entire world in less than a week. And yes, sometimes day 3 of the close overlaps with the external auditors demanding 500 sample invoices, right while the IT department decides to push a security patch to SAP S/4HANA. It is absolute chaos.
So how do you answer the question without sounding like you just survive on coffee and panic?
You use the STAR method to show that you impose cold mechanical order on the chaos. You don't just say, "I work really hard and stay at the office until midnight."
Because everyone does that. It's not a differentiator.
Exactly. That's a weak answer. You detail your exact operational triage process.
Walk me through that triage. What do you actually do on day 1 versus day 3?
You explain that you handled the foundational system-dependent elements first before the IT update can lock you out. You say something like, "My first priority is locking down the accruals and ensuring prepayments are amortized."
Hold on, let's look at the bricks before we build the house here. For someone who understands general business, but maybe hasn't worked in a massive accounting department, what exactly do we mean by locking down accruals under time pressure?
An accrual is essentially recording an expense for a service you've used this month, even though the vendor hasn't actually sent you the physical bill yet.
Okay, give me an example.
For example, you know the marketing agency ran a massive ad campaign in France this month. You haven't received the invoice, but you must record the estimated expense in the current month to ensure your profit is accurate.
So you can't just wait for the bill to arrive next month?
No, that violates the matching principle in IFRS. Under pressure, you have to hunt down the marketing director, get their best estimate of the cost, and manually book that accrual journal entry into SAP before the system locks.
And prepayments, what are those?
The opposite. You paid for a 1-year software license up front in January. In March, you have to amortize it, meaning you move 1 month's worth of that cost from an asset on the balance sheet to an expense on the income statement.
Okay, so you lock those systemic things down first. What next?
Next, you finalize sub-ledger reconciliations.
Subledgers.
Yeah. Think of the general ledger as the master scoreboard of the company. It just says, total cash, 100 million. The subledger is the detailed list behind that number. Every single bank account in every country detailing every transaction.
And they need to match.
You have to make sure the subledger perfectly matches the master scoreboard. You tell the interviewer that you triage these tasks based on material impact. You fix the 10 million euro discrepancy before you look at the 100 euro discrepancy.
You show them that when the house is on fire, you let the small fires burn while you save the main structure.
Beautifully said, yes.
I triage tasks based on material impact. That proves you understand scale. Now, another massive fire that is guaranteed to come up in this interview is the intercompany mismatch.
Oh, it is the absolute bane of every corporate accountant's existence.
Why? What makes it so difficult to solve?
Let's go back to our Heineken example. Let's say the subsidiary in Germany grows hops, and they sell those hops to the Heineken brewery subsidiary in France.
Okay, internal sale.
Right. The German entity records a revenue and an intercompany receivable, meaning France owes them money. The French entity records an inventory expense and an intercompany payable, meaning they owe Germany money.
Seems simple enough.
In a perfect theoretical world, when the corporate team in Amsterdam consolidates the global books, those two amounts match perfectly. The system eliminates them against each other, so the company as a whole isn't showing fake revenue from just moving inventory between its own pockets.
But I'm sensing the real world is not perfect.
Not even close. Because of timing differences, like the goods left Germany on the 30th but didn't arrive in France until the 2nd of the next month, or currency fluctuations, or just simple human error, they almost never match initially.
And when you have hundreds of thousands of these microtransactions happening daily across a global network,
Finding that mismatch is literally like finding a needle in a massive multi-currency haystack.
And isn't there a massive tax implication here as well? I mean, governments want their cut of international sales.
Yes, transfer pricing. You have to ensure these entities are selling to each other at a fair arm's-length market value.
Yeah.
If Germany sells to France at an artificially low price just to shift profits to a lower tax jurisdiction, international tax authorities will levy massive, massive fines.
So you aren't just matching numbers. You are enforcing international tax compliance.
It's a massive, tangled web of risk.
So how do you prove to the interviewer you can untangle it?
You explain your proactive process. You don't wait for day 3 of the close to look for mismatches. You explain how you run automated reconciliation reports in Workday or SAT on day 1.
Getting ahead of the fire.
And crucially, you highlight your communication skills here. You have to show you have the cultural diplomacy and the Dutch directness to get on a call, tell the German controller and the French controller they have a 500,000 euro variance, and force them to agree on an adjusting entry immediately.
That perfectly sets up the next high-pressure mock question from the guide. The interviewer looks at you and asks, "Tell me about a time you discovered a significant accounting error post-close. How did you handle it legally and operationally?"
This is a brilliant, multi-layered question. It tests absolutely everything at once.
It feels like a trap again. Admitting you found a huge error after the books were supposedly locked and finalized and reported.
Again, we return to the foundation. Dutch directness and absolute integrity. The absolute worst answer you can give is to imply you've never made or missed an error.
Because everyone has.
Right. The second worst answer is saying you quietly fixed it the next month and didn't tell anyone. This question tests your moral compass. You own the mistake immediately. That covers the cultural aspect.
Okay, so you confess. You say, "I found an error." Then what?
Then you detail the operational fix using STAR. How did you actually go into the ERP system, open up a closed financial period in SAP S/4HANA, and post the adjusting journal entry with the correct audit trail?
Showing you know the mechanics of fixing it safely.
Yes. And finally, you cover the legal and IFRS compliance aspect. You explain how you assessed materiality.
What does materiality mean in this context?
Was the error so massive that it required a legal restatement of previously published financial statements to the public? Or was it immaterial enough that you could simply run a catch-up adjustment in the current period's retained earnings? You walk them through the entire anatomy of a crisis and its legal resolution.
You are showing them you don't panic, you don't hide, you just execute the fix methodically. Okay, we are coming to the end of the gauntlet here, and there's an ultimate quality check.
The final philosophical hurdle.
Yes, a final question the interviewer will ask to see if you truly have the mind of a top-tier corporate accountant.
Yeah.
They'll ask, how do you know if a number is right?
It sounds like a trick question, like a riddle, but it's intensely practical.
Right, because if you have 50 million transactions processed by an automated SAP system this month, you cannot physically check every single invoice to see if it's right. So how do you know?
You confidently explain your mastery of flux and variance analysis.
Break that down for me. What is flux analysis?
You don't look at the micro details, you look at the macro trends. You explain how, on day 2 of the close, you run a comparative balance sheet and P&L. You are looking for anomalies before the books are locked.
What kind of anomaly?
Well, if the software subscription expense line item in the UK is suddenly up 400% month over month, you don't just accept it because the system calculated it. You dig in.
You investigate.
You compare the actual numbers against the corporate budget, against the quarterly forecast, and against historical trends.
You're looking for the story behind the numbers.
Exactly. You call the UK department head and ask, did you buy a massive new software package, or did someone accidentally accrue a monthly invoice as an annual expense?
Human error disguised as a systemic fact.
Right. If the operational story doesn't match the financial data, the number's probably wrong. You prove to the interviewer that you aren't just a calculator passively accepting data. You are a financial detective aggressively protecting the integrity of the balance sheet.
That is the perfect encapsulation of the role. Okay, let's take a breath and recap the mission today. We have completely unpacked the architecture of this interview. If you want to conquer the Amsterdam MNC boardroom, you need to master 4 distinct pillars.
4 pillars, exactly.
First, the cultural fit. You must navigate Dutch directness with unshakable honesty. You cannot tap dance.
Yeah.
And you must prove you can be a collaborative business partner across a hyper-diverse, cross-time zone global landscape.
That's step 1.
Second, the systems capability. You must prove you are operating at the modern edge, moving far beyond basic Excel to master Tier-1 ERPs like SAP S/4HANA. And you must have a quantified, highly specific story about implementing enterprise-level automation, like an OCR workflow.
Step 2, the digital tools.
Third, the technical gauntlet. You have to fluently speak the global language of IFRS. You must be able to walk through the mechanics of multi-currency consolidations, right-of-use assets for global leases, complex revenue recognition for bundled contracts, and strategically deploy your knowledge of future structural changes like IFRS 18.
The rules of the global game.
And finally, the operational core. You have to use the STAR method to prove you can synthesize all of this under the crushing, chaotic pressure of a 3-day month-end close, triaging accruals, fixing intercompany mismatches, and performing macro-level variance analysis to ensure the numbers are bulletproof.
If you can articulate those 4 pillars with detail and confidence, you aren't just surviving the interview, you are completely dominating it. You become the obvious, undeniable choice for the role.
But there is one final critical piece of this puzzle that changes the entire dynamic of the conversation.
Yes, and this is something you really need to internalize as you prepare for this.
If the Dutch corporate culture truly values transparency, flat hierarchies, and raw honesty, then this interview is absolutely not an interrogation. It is a two-way street.
Precisely. You hold immense power in this dynamic, too. They need you just as much as you need them.
When you walk into that glass boardroom in Amsterdam, or when you log onto that final video call, armed with your knowledge of IFRS 18, your mastery of SAP architecture, and your proven ability to automate massive global workflows, you shouldn't just be sitting there hoping you're good enough for their company.
You need to flip the script entirely.
You should use that same as Dutch directness to interview their tech stack, their closing processes, and their culture.
Ask them how automated their intercompany reconciliations actually are. Put them on the spot.
Ask them if their finance team truly operates as business partners with operations, or if they are still secretly stuck in a back-office silo. Because the real question isn't just whether you can survive their gauntlet.
No, the real question you need to answer for yourself is, are they evolved enough for you?